When the market was down, Michael, I was thrilled. When other people were panicking and selling, I
Hmm.
was buying more shares at discount prices. My only regret was the market wasn't down more during that 6 year period because I'd even done better than that. But what really
Wow.
surprised me wasn't the returns, it was the math. My first double occurred in just 30 months, second one 13 months, third one 29 months, for an average of 24 months, way less than half the 86-month time period that's expected.
You are listening to 5 a.m. podcast. Your morning motivation starts here. Yeah, your motivation starts here.
Welcome back to the 5am podcast. I'm your host, Michael Clausen. Now, it has been said that experience is what we get when we didn't get what we wanted. And today's guest is the living embodiment of turning a setback into a life-changing step up. So at 63 years old, after a 40-year career, David Nassif was shown the door. He had 2 years of savings left and a retirement math problem that looked impossible to solve. Instead of fading into that background, stripped away the noise, and he built a strategy that took him from nearly broke to a millionaire by age 69. He's the author of the Amazon #1 bestseller, The One-Page Wealth Compass. So whether you're 35 and you're trying to escape that 9 to 5 cubicle trap, or you're 55 and you feel like those walls are closing in, David is here to show us that clear direction beats misdirected speed every single time. David, welcome to the 5am podcast.
Michael, I'm thrilled to be here. Thank you so much for inviting me today.
Oh, yes. Looking forward to this conversation. Now, interestingly enough, David, you described yourself as a chihuahua in a junkyard dogfight. When you were fired at 63, what was that very first thing that you had to unlearn about money in order to survive the fight?
Well, the first thing is I had to unlearn everything I had done for 40 years because what
Mm.
I had done for 40 years got me on the brink of financial disaster. And you'd
Ah,
think somebody who had a decent paying job most of his life, really above
right.
average income, would not be in that situation, but I was. And I thought I was doing everything right. I thought I knew money because I was making good money. See, that's a mistake I made. Because I was making good money, I thought, oh, I understand money. I know, understand how to build
Mm.
wealth. Well, there's two separate skill sets right there. Totally.
Yeah. Yes, absolutely. And of course, even children, when they get a birthday card, hey, thanks, let me tear this open and see how many bills or what kind of bills are inside. And so money is one of those things that's on the top of a lot of people's minds. You realized you'd be broke by 65 if you didn't change something. Why do you think that so many professionals, maybe even high earners like doctors, ignore this brutal math problem until it's too late?
I think for me, anyways, it was just one, I overestimated my ability to invest in and build wealth. Okay. I didn't
Hmm.
know what I was talking about because I was listening to all the noise out there. There's so much conflicting noise out there, that
Yeah.
so many conflicts of interest, and you're just bombarded constantly with it. And I didn't really recognize that fully, I don't think, for 40 years. And the other thing is, I was a master procrastinator. I mean, I had that down
Mm.
so well. I just knew how to procrastinate excellently. And like I say, interesting statistics, you mentioned doctors. 25% of doctors in their 60s don't have a seven-figure income. They only, I mean, a seven-figure
Mm.
portfolio. They only have a six-figure net worth. And that's
Yeah.
shocking when you think the money they make. So it's not like this is not like an uncommon, rare thing that happened to me. It's fairly,
Right.
unfortunately, too common in our society today.
Yes, because I know in your book, you can correct me if I'm wrong, but you talk about how there's a janitor retired with over $8 million, while doctors end up, like you say, with only six figures. And you think, does that only include your house, doctor?
Yeah. Let me tell you something even more shocking than that because
Okay.
it makes a very important point. Pro athletes, the average NBA player makes over $10 million a year. I didn't say in his
Oh,
lifetime, I said in a
okay.
single
A
year.
year.
Yet
Yeah.
after 5 years retirement, 60% of them are broke, according to the Netflix documentary Broke. And the NFL is even worse. The
Wow.
NFL, after only 2 years of retirement, 78% of them are either bankrupt or facing serious financial stress. That's according to Sports Illustrated. Now compare that to Dale Schroeder, a basketball loving carpenter who earned a
Okay.
modest to below average income his entire life, yet he chose to live on less than he earned, invested different wisely. He ended up with a $3 million portfolio. Michael, that's more money than most NBA and NFL players had at their end of their career. And yet
Wow.
he was a modest income earner below average. So people who think, oh, I don't make enough money to really invest, I'm just not,
Hmm.
that's a lie too.
Yeah.
That's not true whatsoever.
Now, there is a piece of advice that I've heard a lot is don't tell people about your money. And does that kind of fit into what we're seeing here? Because you see the Instagram ready players and you see the fame and the notoriety they have. And it's like, they're making it rain or flashing their cash around. In your research, did you find that about being secretive about your wealth is better than being a loudmouth about the money?
I don't think that piece matters, although most wealthy people
Okay.
I know of tend to be less boisterous about their money.
Right.
But what those Instagram or TikTok people they can do, and I'm not going to sure there's a percent of them that are fake. I mean, it's just like
Okay.
life. Okay, but let's
Yeah.
say that there's a percentage of them that are truly making seven figures a year or whatever, making money, and they're throwing money around crazy. I don't question that they're making a ton of money. My question is, do they know how to invest it? Are they building wealth? Because those very same people, when their TikTok fame is over or whatever, they could be like the
Mhm.
basketball players, football players, within a matter of years, be broke.
Yeah.
And so it's like I say, it's two separate skills. And just because you're a pro at one, I was a pro at making money for 40 years. I was lousy at
Mhm.
building wealth. Dale Schroeder,
Interesting.
he was a pro at building wealth, but he was pretty lousy at making money. So it just depends, on your situation.
Well, and we hear a lot of people might say, "Oh, I'm chasing money down. I'm chasing it down." And I think of some of my upbringing experience of hunting and knowing that you can't chase that deer or that moose that you're after. You have to be like shh, and hunt and bait the trap. And is there any parallels there from your experience of the hunting versus the chasing down the money?
I think the hunting is more on the earning income side of it. I think
Okay.
there is some hunting there involved, in terms of looking for opportunities and increasing your income, that kind of thing. But when it comes to the building wealth part, it's a
Hmm.
pretty boring. The way I did it, anyways, and the only way I know
Yeah.
how to do it is pretty boring and pretty step by step. And there's not a lot of excitement in it. But what the excitement comes is when you start seeing that compound really accelerate. That's the exciting part of it, and I'm very
Hmm.
excited about that piece of it. But and especially in the beginning, it's pretty slow process, kind of like a flywheel. But you don't have to wait 40 years. That's the whole thing. I only, I did it wrong for 40 years. For 40 years, I did it
Right.
wrong. After I got the compass, my one-page wealth compass, and I figured out how to do it, I did more in 6 years than I
Wow.
couldn't even come close to in 40 years. That's the
Mm.
power of clarity. That's the power of focus. Let me share with you what inspired this whole
Yes.
thing. When I got
Okay.
fired, it was devastating. Okay, I'll admit that too. And the worst part was telling my wife we'd been married for 30 years and she did not deserve the
Mm.
mess I threw our life into. But it was difficult. But when I did decide to break loose of that whole thing, I says I got to do something different here because I'm not going to curl up in a corner and just go away. This is
Mhm.
not going to happen to me. And I started my own company. It was hard at first, extremely hard at first, but I did get it going. And then when I started making good money, here's the thing, Michael, that made me concerned is, yeah, I was making more money now than I was at my corporate job. But my point is, I still didn't know how to invest it. I still didn't know how
Mm.
to make it
Mhm.
make wealth for myself. And I had done that for 40 years. I'd made pretty much most of the time above average income. So that wasn't the solution. So here's what happened. I heard this story, and it was a true story about the same time it happened. Scientists at the
Okay.
Max Planck Institute did an experiment. They placed people in the center of a dense German forest, and they told them to walk in a straight line to the edge. Now, these were confident and capable people. But
Wow.
when the clouds covered the sun and they lost their point of reference, the GPS tracking showed they were gradually starting to walk in circles. And some of them were
Yeah.
ending up right back where they began. But every single one of them was absolutely convinced they were walking in a perfectly straight line. Michael, that is my life story for 40 years. Working
Wow.
hard, making decent money, doing what I thought was right when it came to investing, but literally going in a circle, and it ended me up right back where I began, actually worse off on the financial cliff. And
Mhm.
that's what inspired the whole thing. I says, no more. I can't do this anymore. I can't keep doing this. So what I did is when I started making good money again, I said, I'm going to figure this out myself because there's just too much. I could tell there was too many conflict of interest. People trying to get you, they want a slice of your income more than they
Yes,
want to help you. So what I did
that's
is
for sure.
I read 21 books, listened to 13 financial podcasts faithfully, read blogs, newsletters. And what happened is every time I got a good idea, I put it on this one piece of paper. I kept picking out, then when the paper filled up, I said, okay, I want to keep it to one page. So when I got a really good idea, I took the least effective idea off the compass and put the better one on there. And I kept
Yeah.
refining it. But my one rule was I had to keep it to one page and I couldn't reduce the type size. I had to keep it, I couldn't cheat. And so by the time I was done, I had this powerful compass that just gave me crystal clear direction, and the noise just kind of went away. The conflicts of
Yeah.
interest in trying to sell me their packages went
Mhm.
away because I got it. I understood it. Benjamin Franklin said the best investment is knowledge. Once I got
Yes.
that knowledge, boy, it just changed the whole game for me. It really did.
Yes. And having that one page versus a 50-page prospectus
Yeah.
or something like that. Can you talk a little bit about why the simplicity matters?
Yes, because it gets results. Let me explain what I'm talking about here, okay?
Yeah.
Within the 6-year period, I doubled my portfolio 3 times. Now, you ask
Wow.
any financial sophisticated investor would say, Dave, that's not possible. The market didn't increase that much. I don't care what you did. You couldn't have done that. It's not even possible. Well, let me assure you, I did. And let me explain why. First of all, I wasn't day trading. I wasn't chasing crypto, or I wasn't trying to time the market. I was doing something
Okay.
so boring it would put you to sleep. What I did is I had an investment approach. And here's the crazy thing about my approach. When the market was down, Michael, I was thrilled. When other people were panicking and selling, I
Mhm.
was buying more shares at discount prices. My only regret was the market wasn't down more during that 6-year period because I'd even done better than that. But what really
Wow.
surprised me wasn't the returns, it was the math. There's a thing called the rule of 72. And what it says is
Yes.
if you're going to get 10% return on your money will double every 7.2 years or roughly every 86 months. Once I developed my compass and started following it, my first double occurred in just 30 months. Second one, 13 months. Third one, 29 months, for an average of 24 months, way less than half the 86-month time period that's expected. So the secret, though, like I said, wasn't the returns. I was doing 3 things. First, I was saving a good portion of my income every month because I knew I had a very short runway. It was more like a helicopter pad. I could not mess up anymore. And so I says, I got
Mhm.
to get serious about this. So I saved a good portion of my money. Secondly, I put the money in the right kind of investments. And I'll tell your listeners right now what I found was the right kind of investments.
Mhm.
Low cost
Yes.
index funds. I only own 2 of them. You can't be simpler than that, I don't think. I only own 2 of them. One of them
Right.
is the total US market. I own every publicly traded stock in the whole United States. My other fund is outside the United States. I own every publicly traded stock outside the United States. So, Michael, I literally own every publicly traded stock on the globe. The only
Right.
reason I'm going to go to zero in my investments is if the entire world economic system were to collapse to nothing. And I'm not too worried about that happening.
Simultaneously.
Yes,
Yeah.
exactly. I'm not
Right.
too worried about that
Yeah.
because if that happens, we have bigger problems than money. So, anyways,
Yes.
but the thing is, the diversification gave me peace of mind. It let me sleep at night. It wasn't a hot shot, get rich tomorrow or yesterday or today. It was a get rich in a very methodical way that actually picked up some pretty good speed. When you ask people, who doubles their money every 24 months? People are going to say, that's not really that possible. I don't know how that does that. Okay.
Yeah.
And the third thing I was doing, I said there's 3, is I use market volatility to work for me instead of against me. Most people, they
Mm.
like to buy high
Mhm.
and sell low because they are emotional and there's
Yes.
the market panic.
That's right.
I got out of that trap because I understood it now. So I pushed out the emotion. What I was able to do is build my wealth twice as fast with half the risk compared to how most people do it. And when I started doing that,
Yeah.
my doubles started occurring a lot faster than I even suspected, to be honest with you.
Right. And so was there any stock market indicators or any trades that you were making by yourself with these two index funds? Like, were you looking for where their moving average was and selling and waiting for it to come back down?
I was not market timing at all. I am not
Okay.
smart. I'm not smart enough to do that, Michael. I mean,
Okay.
maybe there's somebody who can, but I can't do that. Here's what I did. I paid
Okay.
myself with my company. I pay myself twice a month, once or twice a month, typically. Okay.
Okay.
When I paid myself, usually once a month, I transferred the money from my business account to my checking account. That was my pay. And then the first thing I did before I did anything else is I took a portion of that and transferred it to my investment account and just put it in those two funds. We're talking
Mm.
a total of maybe 4 to 5 minutes a week. That's all it took me.
Yeah.
I tried what you were saying. One day I
Yes.
remember the market was like going down in the morning when I was having breakfast. I saw on TV. I
Yeah.
said, okay, I normally do it in the morning. I said, I'm just gonna wait till the afternoon, just because why not capture
Yeah.
some of the lower market? Well, by the
Yes.
time the afternoon was up, the market was up again, higher than it was in the morning. That cost me
Mhm.
$250 roughly. I mean,
Wow.
some change to
Yeah.
wait. After that point, Michael, I says, no more market timing. When I'm done
Yeah.
with breakfast, I'm doing the transfer. If the market's up, if great. If the market's down, great. If it's stagnant, great. I don't care what it is.
Yeah.
And when I did that, I didn't have any indigestion anymore for breakfast. It just was
Right.
much more relaxing and much more calm. I don't do any kind of market timing. I'm not smart enough, and I don't even try to attempt
No,
it.
that's good. And that's good. I had a stockbroker many years ago who would always remind me that pigs get fat and hogs get slaughtered.
Okay.
And so now you've mentioned people will work extra years because they never calculate their financial freedom number.
Oh, yeah.
So for somebody listening right now, what's the simplest way to find that particular number?
It's real easy because it's only 4 steps, and it's not complicated. A lot of investment advisors want to make it complicated because then you have to
Yes.
hire them to do it for you.
That's
You
right.
you don't need to hire anybody to do this. First of all, it's 4 simple steps. First step is identify what your living expenses are going to be, or what you want them to be, or what they are, or whatever. Okay, and let's just, for simple numbers here, say it's $100,000 a year. You said to yourself, hey, if I had $100,000 a year income in retirement, I'd be comfortable. I could live the rest of my
Mhm.
life comfortably. Okay, all right. So that's the first step. The second one is to less subtract any guaranteed income you're going to have. Social Security, pension, annuity. If you're from another country, most people have some type of
Mhm.
government type thing. Okay, whatever that is. Say it's $24,000 Social Security, just for the example. Okay, so then
Yeah.
the third step is you take the difference in those two numbers. You take the 100,000 minus the 24,000. That's $76,000, and that's the money your portfolio needs to generate roughly on
Mm.
average, every year for you to live comfortably at $100,000. Then the last step is you take that number, that 76,000, and you divide it by 5% or whatever your withdrawal percentage is. I'm just
Mhm.
using 5%. It's not that uncommon. That tells you when you take the 76,000 divided by 5%, that's $1.52 million. So when your
Wow.
portfolio hits $1.52 million, you've hit your bullseye, you've hit your target. And if you love what you're doing, keep on doing it. But if you're saying, I want to get out of the rat race, I want to move to Canada in a small town where they bring the eggs to my house
Yes.
and when they say,
Yeah.
then you could do that too. It's kind of your choice. But now the bullseye. Compare that to Kurt. He was a engineering draftsman person, okay, and what
Okay.
he'd been 60 when he was 60 years old. He did the calculation. He determined he needed $1.4 million to retire. He was
Mm.
60. He looked at his investment accounts. He looked at his portfolio. He looked at his retirement accounts. They totaled $2.4 million. He could have
Mm.
retired possibly 5 to 10
Wow.
years earlier. He just didn't know his number. It's hard to cross the finish line when you don't know where the finish
Yes.
line is. That's the kind of thing.
Yes.
And so it's not complicated. It's those 4 steps. It's in my book. It's just easy to do. You don't need my book. You can just calculate it right now. And that's pretty much
Mhm.
what it takes.
Yes. Benjamin Franklin has this saying, there are 3 faithful friends, an old wife, an old dog, and ready money. So can you talk about the family factor in this, of what was your wife or your family's response to what you were doing?
Well, my son was pretty much an adult, young adult, I
Okay.
should say. So he didn't really have a lot of input, although he did learn from me and he started doing the things I was
Okay.
doing. But my
Yeah.
wife, she just supported me. She's not a financial person. She doesn't really get involved in that piece of it. And the funny thing is, once I really understood it, I love to watch the morning financial shows, not for any advice. I would never take a
Mhm.
single piece of advice from any of those
Yes,
people,
that's for sure.
but I find them entertaining, and I like the history of companies and the way they talk about it. I just find it,
Mhm.
you know. And so, anyways, one morning I was having breakfast, and the guys talking about how the market's going to tank, and you better, pull out of it, and you
Mm.
better get into cash, and I'm laughing, and my wife says, "Honey, why are you laughing? That guy's serious, and he's got those credentials. He's from Wall Street." I go,
Yes,
"Honey,
right.
he don't know what he's talking about." Let me explain why I say that. Warren Buffett says the two things. There's something when it comes to forecasting. Here's what
Yeah.
people know about forecasting. The forecast tells you a lot about the forecaster, but it tells you nothing about the market. And that is so true. They're half the time they're wrong, half the time they're right. Well, their job on those on those financial
Yes,
shows is to get people hyped up, because then they're going to want to watch it more, and the ratings go up, and they can charge more for the commercials.
that's right.
That's nothing you do for investment advice. That's the last thing I would do. So it's so funny. So she was supportive after she understood it. Then she just kind of rolled her eyes when the market's
Mhm.
down. I'm like really happy when the market's down. It's like most people are like, "Oh, no, 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 no," because I'm buying it on sale. How many people go to
That's
the
right.
department store and they go 50% off? Do they ever say, "Hey, I don't want to buy this at 50% off. Tell me when it's going back to full retail. I'm a full retail buyer." No one would ever do that.
Yeah,
But yet we do it all
right.
the time in the stock market. Oh, the market's down half. Oh my gosh, I got to get out. It's got no. That's when you want to buy.
That's right.
For 200 over 200 years. Every time the market has tanked or went down, it is not only fully recovered, it has gone on to new heights. That's over 2 centuries of data. 2 centuries of data
Yeah.
is good enough for me. I'm very comfortable when the market's down. Matter of fact, I'm happy when the market's down. So, anyways, I know I sound crazy, but that's
Yes. Oh, no, that's good. And further to your point, Warren Buffett, he has said, "I make no attempt to forecast the market. My efforts are devoted to finding undervalued securities." And how can you go wrong with Warren Buffett's
yeah.
information and mindset? We may hear this phrase a lot, but for a 25-year-old listener, what that set it and forget it that we would hear from Ron Popeil, what does that look like to you in investing and in what you've been able to accomplish?
Well, that's my whole philosophy, is to set it and totally forget it. I don't think about the investments. I don't think about the stock market. I check my investments once a month just because I just want to make sure it's still there. If someone didn't hack into the system or whatever.
Hmm.
Not that they ever would.
Yeah.
There's so many security, and it's all insured. But I'm just saying, anyways, I just like to check it once a month. But I truly do forget it, because when you make it so simple that you don't have to obsess about it, you can go on with your life. What I did is
Yes.
I knew I wanted to build my business up. Last year, I've been so blessed with my business, and it's because I've been able to give my full attention to it and not worry about the investments in the stock. When you only own two
Hmm.
investments, it's kind of hard to stress about it, because you just
Yes.
put the money in two investments and that's it. And I own Warren Buffett's company. I own every company on the planet, so I don't worry about it. So that's the thing. I think set it and forget it is the only way for the average I'm not saying Warren Buffett. He's a much more sophisticated person than me in investing. But for the average person who's a doctor, who's a plumber, who's an
Hmm.
accountant, who's an electrician, who's an attorney, or whatever, a waitress or waiter, for all of the rest of us like that, we want to set it and forget approach. It worked wonderful for me. I don't need to. Now I want to go on and live my life. That's the deal.
Hmm. Yes. And further to that point, Charlie Munger had said that one of the greatest ways to avoid trouble is to keep it simple. And that the confusion is where other people get to have us part with our money so they can be rich. And certainly to earn the highest returns that are realistically possible, you should invest with simplicity. That's from John Bogle.
Yep.
And so as we're going, let's talk about safety factors. There is the song Safety Dance. What's the specific safety factor that you've discovered that older investors, maybe 50 plus, need to look out for, maybe that younger investors might ignore or throw caution to the wind?
I'm probably not your typical investor since I've got my compass, but it's working so well for me. I don't invest any
Mhm.
different than my 33-year-old son in terms of and I'm 72 now. I mean, my gosh, I didn't think I'd live that long. No, just kidding. I just, I mean, I'm definitely a senior by every standard on the planet. Okay.
Right.
So I should
Yes.
be 50% bonds and 50% stocks or whatever.
Yes.
I don't do any of that. As long as I'm earning and investing and I don't need my portfolio to live off of, which a 50-some-year-old doesn't either, even though he's getting closer to 65. Let's just assume he's going to retire at 65. He's got another 15 years. Why the heck would he put money in bonds and slow down his
Yes.
progress? That's crazy.
Totally.
Now, when you're 5 years away, 3 years away from retirement, shifting a portion of it to bonds because you're going to need that portfolio to live off of, wise. But for a 20, when you're anybody who's 10 years or more away from retiring and needing their portfolio for income, I say invest like a 20-year-old, a 30-year-old, a 40-year-old. Put it all in equities. That gives you your best long-term returns. And when you get close to retirement, then start going back and saying, okay, now I need to put some money in bonds. And if you're the kind of person who's very wealthy and you're never going to need your portfolio for your income, which is a very small percentage of our society, then you may never go into bonds because if it doesn't affect your life, if the market were to tank by 50% and you aren't living off of your portfolio because you have enough wealth, then what does it matter? You're going to sleep just fine at night, that kind of thing. So that's my position on that.
Yes. No, that's good. And ladies and gentlemen, we have a comment section and we love to hear from you. I'm chatting with David Nazif, and we would love to find out what your thoughts are on your investment struggles or your maybe saving ability or not. So put that into the comments. And now, David, I want to be able to ask you about the book itself and that compass. And it started with that one page. Was there one sentence or a couple of lines that you wrote on that page in the early days that has really stuck with you and said, yep, I can take that one all the way to the bank?
There's been a number of them. I'm just going to show it to you. By the way, I'm going to give this to all of your listeners for free at the end of the show. So I'm not here to pitch anything, but it helps if you can see it. Okay. Basically, my Wealth Compass has two columns. Okay. The first column is my 9 trail markers. And this is nice because what you can do is when you first look at the compass, you can say, where am I at on it? Where my first number 1 is career and income success. Most financial books I read, they never brought up about earning the money. They assumed you're already making all the money you need. That isn't true. A lot of people aren't making the money they really want to make. So I have the whole first step is about getting the kind of money you want, getting yourself to maximize your income potential. I have 2 chapters on that because there's just so many. Most of my life, the one thing I was really good at most of my life is making good money. I made quite a bit above the average income. And a lot of the tips and things are here because that's not right for everybody. Not everyone's making all the money they want. But then it goes down to things like, I'll just skipping over some of these because they can get this for free. Debt freedom. One of the first things I recommend is before you even start investing is get out of your consumer debt like credit cards and car loans, things like that. Because those are all either depreciating assets or they're no assets. You had a dinner out and you charged it. Now you're paying for it. So you want to get out of that because it's much better to have interest working for you instead of interest working for other people to make them wealthy. And until you get out of that trap, you're spinning your wheels. And a lot of people they talk about interest arbitrage and, I can make more here. And so I'm going to go into debt and pay less. That's goofy. They don't take into account the risk factor. What happens if you lose your job? What happens if the economy tanks and your investments tank? And now you're in the worst possible situation because you had this arbitrage investment strategy that was so good when times were good, but not when they don't take in the risk factor involved. Get out of that risk factor. It's just not worth it. It's just not worth it. Okay. Wealth accumulations, pre-funds. So that's a really interesting we can talk about if you like. Evergreen portfolio. So your financial freedom number. So basically what you're going to do is you're going to find out where am I at on this and then start from where you're at. But on the second side, it's the North Star principles. If this ever happened to you, Michael, where you're going along somewhere and then all of a sudden a shiny object came or a hot tip came and all of a sudden you're off to the races in the wrong direction. Well, that was me for 40 years. So I know what I'm talking about here. So I need principles that are guiding lights like a North Star. So I don't go off the rails like these pro athletes and the doctors and all that kind of thing. And so these are the first one, right? I'll read the first one. Live on less than you earn. I mean, I know that sounds simple, but that's what the people who are, if you're in trouble financially, that's the number one source probably. You're living on more than you earn, basically. And
Yeah.
that's the reason for people's stress and finances. So anyways, when you listen to, so debt freedom, then then this is the 30,000 foot view. Michael, this tells you, okay, are you going in the right direction? But some people say, well, David, okay, but tell me the specifics how to get out of debt. I mean, I get a good principle.
Yeah.
Okay, well, that's where the book comes in, okay? And basically, this is the ground map, okay? This is turn right here. Take a left at the stop sign. Take a right at the light. Okay, and it gives you the details, what you need to know. So when you put these two together, you got the 30,000 foot view, but then you got the ground game. And when you put them together, no one's going to fool you very easy because you understand what's going
Yeah.
on. And what's nice about this is it's a 3D approach. Say you're on step 3 and you want to know how to get out of debt. It says go to chapter 4. So you just look at the chapter 4. And so you can go right to where you need to go for where you're at. So it's really designed to customize it to where you're at in your financial life, not a standard thing
Right.
that everyone has to follow and everyone plug in to the first one first and work way down. Does that
Mm.
make sense?
Yeah, that's good. And so, as you have whet people's appetite, so tell people how they can get in touch with you and get
Sure.
this information.
Go to onepagewealthcompass.com. It's real simple. And the first thing you'll see is grab your download for free. Okay. And it's a one-page download. Look it over, try it out, see where you're at. And then if you want the real super clarity, the kind of clarity most people never get, then get the book. It's
Mhm.
a companion partner. And then you'll be able to get the details so people can't, I even talk about in the book, the 3 C's, 3 different conflicts people face in the financial world and in everything in life. And once you understand that, you're not tricked nearly as easy or fooled. And some people are tricked and they don't even know they've been tricked. They don't even understand what happened to
Mhm.
them. And they just have a lot less money at retirement than they would have had if they didn't know what was going on, that kind of thing.
Right. Absolutely. And so, in your example of being let go at 63, when you have that expectation after being in a career for a certain number of years, that can be a pretty massive blow to one's identity. How
Yep.
did you manage that mental noise of being fired while still trying to build a financial bridge?
Well, it was tough. Matter of fact, when I remember when I first got fired, about a week or 2 after I got fired, I was like in a daze sending out resumes, but
Mhm.
it wasn't getting anywhere for that, you
Yeah.
know. And everyone that I sent a resume to kind of confirmed the company that fired me. Yeah, they said you were of no value, and we all agree with it. You're of no value.
Yeah.
So I was just like I felt like hopeless. I remember my wife asked me to go to the store with her that one day because she said, "Honey, there's a big sale. I want to conserve money. Would you mind going with me?" So I went. It was a discount store. I get there, Michael, and I'm sure this isn't true, but I felt like I was the only man in the store. And there's all these
Mm.
women with their babies and the baby carts crying, and I felt like I didn't belong here. This is a work day. I'm supposed to be working, earning my money. And so my wife's shopping with a checkout. I'm at the checkout, and I felt like I had a sign on my chest, "Biggest loser in the store." I just like I wanted to scream. I wanted to break out of here. I just want to get free of this. But there was nowhere to go. I mean, I wasn't like I wasn't trying to get hired. I just couldn't
Yes.
get, no one wanted to hire me. That's when I decided I can't do this anymore. But my whole life was tied up in this, my image of an executive and a company car and suits and traveling, in some cases a private jet or first class. I mean, that was who I was, I thought. And then
Mhm.
I found out, no, that wasn't who I was. After
Yeah.
I was able to recover, I realized I'm only 3 things. I'm a child of God. I'm my wife's husband, who I love dearly, my wife, and I'm my son's father. And no one's going to take those titles away from me. No one's going to take those away from me. And
Mhm.
that's I don't need the other stuff. I don't miss any of the other stuff. I'm happy without it, actually.
Yes. And so, based on that, is there something that you would go back and tell your 30-year-old self about how to position himself, maybe emotionally, spiritually, or financially?
Yeah, I would say this to my 30-year-old self. Okay, this is a financial compass. So we talked about this before. But the thing is, and
Mhm.
that's really good, and that's what I publicly share with people. But I also have other compasses, Michael. I have my spiritual compass that keeps me same principles of truth that follow for my life. I have a health compass. Okay, for my health, simple principles of truth. Now, this is not complicated. It's not all really. This is simple stuff. And I tell you, if I'd have known that when I was younger, I would have been so much better off, not just financially, not just spiritually, not just health wise, but in any critical area of my life. So I would tell that younger person, find truth and make it simple and put it on one piece of paper. What I do every week, I take 2 minutes, Michael, 2 minutes and review this. 2 minutes. Have you ever read a really good book and you had an idea
Hmm.
and it was like, wow, that's going to change my life. And then 2 years later,
Yeah.
you come across the idea and you go, oh yeah, I meant to do that. I never got around to it. But when you're looking at this 2 minutes a week, you can't do that because say you're in debt and after the third week you keep seeing debt freedom strategy, that's where you're at and you're not making any progress. It's like, I got to do something. I can't just go.
Yeah.
This is a great behavior modification in a gentle but direct way to get you to actually do it. Take steps, baby steps. This is not complicated. This is real simple. I'm not a smart person, but so I had to simplify it for me to understand. And it's there's no
Yeah.
financial jargon. One thing about my book is it's crazy. I'm not here to pitch it, but I'm just saying it's written about stories, real life stories about me and other people I know, people who succeeded, people who failed. I've had people tell me, David, I tell you, the stories are so interesting. The book is worth it just for the stories. But when you put the financial stuff in there, it really brings it together. Let me just share with you one quick review because it
Yes,
just makes an
please.
important point.
Yeah.
This is a clinical psychologist with 25 years experience, no financial background, no financial information. He was facing his own career crisis. He says, the one-page compass gave me the exact financial hope and practical steps I needed. But here's the part I love the most in this quote. He says this, I couldn't put the book down. That's what I mean.
Nice.
It's written for the non-financial person, for the person who just doesn't. When you hear the story and you see the right way and the wrong way, people are saying, now I get it. I've heard those terms before. I never understood what they were. But you make it so clear with your stories. I want to make it so everybody can understand it, not just financial people.
Right. And there are thousands and thousands of books. And of course, ladies and gentlemen, not financial advice, but a great conversation and great information from David. So, David, with thousands of financial books on shelves around the world, what was the one thing you felt like you didn't see being said that really forced you to write your book?
I think what really made me want to write my book was I felt like somebody handed me a lifeline in the middle of a dark, life-threatening storm, and I was
Mm-hmm.
given a way to freedom. And the lifeline was the inspiration for this one-page compass, which, Michael, I never meant it to be shared to people. This was for
Right.
me. This is a private thing.
Yeah.
But I says it's the ultimate in selfishness not to share that to other people. So I just felt like I read a ton of books, and my degree's in accounting, if you can believe it. I never really practiced much a couple of years. I just didn't like accounting. It was very boring for me.
Right.
But so many of the books I read were like they were written for like an accountant type person, and even the good ones were written kind of like an accountant type person. And I go, geez, most people aren't that way though. They don't want to learn that way, and that's why I felt like I need to. Even the best. I've had people compare me, and I'm not saying this to brag. I think, but some of the best-selling financial books. This is, but David, yours is so interesting. The difference is yours is I can read it and not fall asleep halfway through. You know, Amazon tells you how many pages on the ebooks people are reading. People are reading the
Okay.
book to the end. It's like that's unheard of. Usually after a chapter or two or whatever, they stop reading
Mm-hmm.
because
Yeah.
they get caught up in the stories, but they're learning at the same time. And so that's why I wrote it, because too many people buy a financial book and after the first chapter or two, it sits on the shelf and doesn't. I wanted them to read it to the end so they could really understand how to do it. That's why I wrote it.
Right. Yes. Well, I have some of those books downstairs on our bookshelves,
Yeah.
and
I got plenty
that's where they sit.
myself.
And some of them are just hard to get into. So it's great that you've got stories, because stories sell, and people love to hear what others have gone through.
Yeah.
And you've already shared a couple of great stories with the carpenter and the Moneyball players. Is there another story that in your research that really jumped out at you and had to go into your book?
Yeah, this is something that this is a version of my book. It's not the exact thing for my book,
Okay.
but it's very close to it. And it's not so much a story as is an example put in kind of a story form, I guess. Most of my stories are true stories about real people. This one is more. I learned so much from other people, what they did wrong and what they did right, that this is sort of a summary of everything. And so let me tell you the biggest financial mistake people make, and this story will solve it, is they are paying tiny termite-size fees that quietly inflict termite-like destruction on their portfolio. And let me explain what I'm talking about. You got two people, A and B, both got out of whatever training they went into, or if any training, and they're starting their career, they're 25. They're going to work till they're 65. They both decide to put $25 a week away for investments. Now, $25 a week is pretty modest, even for, average income people or below. And so anyways, they both do that for the whole 40-year period. What happens is person A puts his money in a low-cost index fund with a 0.03% annual management fee. Person B
Mhm.
goes to an advisor who charges a full 1%, which is standard, and they put him in an active fund with a 5.75 upfront load and a 0.66% ongoing management fee, which is not uncommon at all. Okay. So we follow these people for 40 years, assume the same historical market returns, the same exact contributions. At the end of the 40-year, person A has a portfolio valued at $1 million. Person B has a portfolio valued at $570,000. That's a
Wow.
$430,000 difference. That's not market timing. That's not bad investments. That is simply quietly termite-sized fees, tiny little fees, eking away day by day, week by week, month by month. And here's the thing
Mhm.
about that that's crazy is that $430,000 difference could make a big difference in someone's retirement. And that's assuming they never got a raise, Michael. If we just factored in normal raises, which might increase that $25, that
Yes.
$430 could even be bigger. Now, here's the
Mhm.
tragedy of the whole story. Person B probably thinks he got great service. He liked his advisor. He knew his kids' names. He went golfing with him a couple times. Little did he realize he did
Yeah.
the equivalent of funding someone else's retirement with half
That's
of his
right.
own money. I am
Yeah.
not against advisors, but I am against products that enrich Wall Street at the expense of their clients' portfolios. And I'm embarrassed to admit this to you, Michael, and I'll say it right now on your show. For 40 years, I never questioned fees. Thought those are the
Huh.
rules of the game. Everybody had to pay them, and
Yeah.
that's the bit. But once I made my compass, I understood the rules we don't question can cost us the most. In person B case, it cost him $430,000 by not questioning these tiny termite-sized fees. That, I think,
Right.
is something that people need to be aware of. And that guy never would have known it. He would have retired with half the money and felt, well, I guess I did okay. No, you didn't.
That's right. Yes. And one thing that we can remember when our broker, mortgage broker, real estate broker, stock broker, when they take us out for a meal, they're using our own money to pay for the meal and they're getting a tax break on it.
You got it.
Yes. Let's keep that in mind, folks. And now, David, you've argued and talked about how grit and direction outperform talent and timing. How can an entrepreneur apply that logic to their business and not just their investments?
Well, I did that. What I did is when I made my one-page wealth compass and I
Mhm.
put it like in a set it, forget approach, I says, okay, now I got to build up my business. And so what I did is I did the exact same procedure. I took not a wealth compass. I took my business, I call it my one-page agency compass. How can I run
Okay.
my agency to maximize my revenue, maximize my growth? And again, same principle. I read books on startups. I read books on sales. I read books on management, whatever it is. And I kept putting these ideas on one piece of paper. And when it filled up, I took off the worst idea and put on a much better idea until I got it really refined down.
Mhm.
And I tell you, that gave me such clear direction in my business. I've had my business now for going on 9 years, and last year we had our best year in our history. And it just keeps getting better. When you have clear direction, it's just amazing how much faster you can go without trying to go
Yeah.
fast even, And so
Yeah.
that's a key for an entrepreneur. If you don't have a one-page blank compass, whatever your business is, I would strongly encourage you to try it, see how it works.
Yes. Yeah, that's good. Now, one of the sayings that we have here at 5am podcast is think it, speak it, see it. We have that on t-shirts and mugs
Okay.
over at 5ampodcast.com/shop. Was there a moment in this period after being fired and building this up where it was a thought that you could envision that you saw come to reality? And how did that feel?
You mean my goal come to reality? I was
Yes. Yeah, that's right. So something that, it started as a thought,
Yeah.
became a goal, became
Yeah.
something that you spoke out.
Yeah, I would say that absolutely. Within the first 10 months of my business, it took me 10 months to get my business to the point where I was making more money than I was in my corporate job. And after about 3 or 4 months, it was, such a grind. I mean, I can't tell you how much a grind it was. But after about 3, I could start to just see the little flicker of a light at the end of the tunnel. And when I started seeing that, it just gave me the hope and the encouragement and the motivation to keep on going. And when I saw my investments, let's switch to investments now. When I saw my investments and they started to build, they started to grow. It's slowly at first, okay, very slowly at first. But when I could say, I said, this is working. I know it's working. And I understand when the market's down, that's not a bad thing. I mean, I remember one year I put a ton of money in the market, Michael, a ton of money in the market. And I had less money at the end of the week. And year year. And I was thrilled. I says, my gosh, what deals I got this year? And boy, the next year when the market recovered, as it always does,
Yeah,
okay, it may not be a year,
as it
maybe 2
always
years.
does.
Okay, all of a sudden, that's I think when the year I doubled it in 13 months. Okay, after that happened, because it was just like, wow, it just exploded. And so, but once you understand this stuff, it's not scary nearly as much as it was when I didn't understand it. I was very scared then.
Yes. Now you've mentioned and you briefly talked about the lifeline already and that you had to share it with other people and you mentioned that it's the ultimate in selfishness to keep this lifeline to yourself. Who is the one person that you wrote this book for?
Well, it was for the person who feels like they're behind and feels
Mm.
like they're just like desperate, And I don't care. I know people in their 20s who feel like that, in their 30s who feel like that, in their 40s and 50s and 60s. So it's not like an age thing at all. It's a person thing. When you just feel like lost and confused
Yeah.
and you feel like
Yeah.
whatever I do is not going to work, so why even try? Why even bother? That's the person I wrote it for because it's not that much of an effort if you understand what you're doing and you can live your regular life pretty well and just still build. And if for those entrepreneurs, let me tell you something, don't you dare be putting all your eggs in one basket and say, well, my company's big, I'll sell it. And
Yeah.
no, no,
Right.
no. But things happen. Really, I
Hmm.
failed in two businesses in my 40s. I failed in two businesses. One plunged me in a serious six-figure debt. So please don't put all your eggs in one basket. Have a backup plan with your own portfolio of wealth building. Keep going your business. Do everything about your business, but don't ignore your own personal wealth too.
Yes, absolutely. And we need that advice from people that have gone before us. And it's never too late. It does sound, as you're talking, that this would be a great book for nieces, nephews, and grandchildren.
Oh yeah.
That's for sure. Now, for the listener who does feel lost in the noise today, what's the very first thing that they could write down for their own one-page compass?
Well, this is what I would say for that person because it's going to differ, but depending on the person. And I
Hmm.
wouldn't want to give one piece of advice that everyone's supposed to do it. So here's what I would
Yeah.
tell everyone to do to get your thing for free. Download this onepagewealthcompass.com and look at the trail markers and find out where the heck you're at on the trail marker and pick it up
Yeah.
from there. Don't say, oh, I'm not far enough down. I'm older. I should be down like point number 6. Or I'm only at 1 still. That doesn't matter. Wherever
Yeah.
you're at, pick it up from where you're at. And then look at the North Star principles to see if you're abusing anything hey, I need to rethink this. This is crazy. That's what I would do. I would just start from where you're at. Don't compare yourself to somebody else, anybody else. I love the quote about, comparison is the thief of joy. There's always
Yes.
somebody better than me. There's always somebody worse than me. And I don't really care. I mean, I hope the best for everybody. I just got to make it better for me. I want to be better tomorrow than I was yesterday, that kind of thing. And
Hmm.
that's what this will do for you.
Yes. Well, that's wonderful, David. This conversation has been great, and it's been a great, let's say, masterclass. That's a buzzword right now that we could use in the power of simplicity and avoiding the chaos. We all want that in our relationships, so we might as well have that in our finances too. Now, you've proven that the clock is not our enemy. A lack of direction and not having a compass,
Yeah.
that's the issue. So, thank you so much for sharing your bridge with us today.
Thank you, Michael. I appreciate it. It's been a pleasure being on the program with you today.
A- Absolutely. I love talking about finances almost as much as that 10-year-old does tearing open that birthday card looking for how much money they got from grandma and grandpa this year. Now, ladies and gentlemen, as you're listening, and if you're tired too of, well, the empty birthday cards and the jargon, and you want to see an actual map that David has used that we've been talking about to hit the 7 figures in just 6 years, he's got a gift for you. You can get the one-page wealth compass PDF for free by heading over to onepagewealthcompass.com. And we'll have that link in the show notes along with a link to David's book. You don't have to take this journey alone. You can get the compass and you can start finding your own financial freedom number today. And maybe this will help you get that annoying debt and those fees paid down and removed from our lives, which would be great. The mosquitoes of the financial world. As always, please, ladies and gentlemen, seize your day. Enjoy those sunrises and sunsets and all those beautiful adventures in between. Thanks for tuning into the 5 a.m. podcast, and we will see you on the next one. I'm Michael Clausen.